Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we welcome Mike Larson, who's Senior Analyst at Weiss Ratings. Welcome to the show, Mike.
Hey, glad to be here.
As you're a new guest on the show, Mike, I thought it'd be good to talk a little bit about your background and perhaps how you got involved within the markets, and also your interest in gold and silver. How did that begin? And did you also have any mentors growing up within the financial world?
Sure. I actually came up originally on the journalism side of things versus the market side of things. I started working at Bloomberg News, following the markets when I was in college. After coming out of school in the late 1990s, I went to work for a company called Bankrate.com, followed the mortgage and consumer finance side of things there, and then eventually joined up with Weiss Ratings, Weiss Research back in 2001. And over the years, I've tended to focus on things like interest rates, asset valuations relative to the credit cycle, and how that can impact things in general, whether it's equities, whether it's bonds, and so on. And my view, and when it comes to interpreting what I think is going to happen in the precious metals market, depends a lot on some of those other disciplines, what's happening in other markets out there, and how it can impact the gold and silver market. So I think I've kind of come around to following the precious metals market more closely as sort of a side effect, or originally wondering about and researching the impact that things like interest rates and so on have on metals. So that's essentially where my background came with. And again, I've been with Weiss Ratings, Weiss Research now since 2001. And I think a lot of my reason for staying here and continuing to follow on this path is really based on our company founder, Martin Weiss, and sort of what he's taught me and brought me up in this industry a little bit from. We've had a newsletter publishing and independent investment research business going back 4 decades now. And again, I joined a couple decades ago, or almost a couple decades ago, and he's really helped to instill in me the benefits of investing with a more conservative approach, considering not just opportunities but risks and so on. And that kind of more conservative, safe money investing style, like I call it, is really what kind of guides my thinking. And with regards to precious metals, I think that this is an environment, and it should remain an environment for the next couple of years, where precious metals very much fit into that sort of conservative approach, where you can generate profits from a typical safe haven investment that has a lot going for it, again, over the next couple of years.
Yeah, before the call, we were talking about a recent presentation you gave, which is called The Great Gold Rush of 2019-2021. And from viewing that was a reason why I wanted you on the show. So let's talk a little bit about the 4 forces that you described within that presentation on how gold will go much higher. And also, many investors have heard how gold should rise and the miners should follow. But it still feels to me as though the average investor is still not interested and does not believe that gold is back in the bull market. So from an investor perspective, what will it take for the mainstream investor to rush back into this space, Mike?
Sure. Well, I'll tackle the forces that I've brought up in some presentations and some other work first. I think that's important for investors to understand. While in the shorter term, you can have things like geopolitical issues, Middle East conflict, and so on impact the price of gold over the next, say, few days or few weeks. I think over the next couple of years, what we're looking at is a more fundamental, powerfully driven bull market. And it stems from a couple of different things. First off, I would say falling interest rates here in the U.S. and deeply negative interest rates abroad are fuel for gold. Gold has less competition when you're in sort of this ZERP, NERP environment when it comes to interest rates, zero interest rates or negative interest rates. Secondly, I think you're beginning to see a nascent return of volatility to the markets, where while stocks have made slightly higher highs here, we've seen more concern about recession risk than we've had probably going back a decade now. We have the credit markets that are in certain corners of the credit market starting to show some volatility, some concern about, say, lower rated corporate debt and so on. And that's starting to factor into the desire for a safe haven investment at the late stages of an economic or credit cycle. Thirdly, I'd suggest that gold, silver, and especially mining stocks are one of the relatively few undervalued asset classes out there in an ocean full of overvalued ones. We have, to some degree, commercial real estate valuations extremely stretched, stock valuations stretched, risky bond valuations stretched, and so on. So there are a lot of asset classes there that are overvalued or expensive, whereas gold, in my opinion, is undervalued and relatively cheap. And finally, I think when you look at simple supply and demand, you have central banks that for many years were either inactive in the market or were actually selling gold, reducing that and rotating reserve assets into other classes. But now you're starting to see not just sort of your big central banks or a handful of central banks here and there, but many central banks in the sort of emerging market world and in some countries where there is more tension growing with the United States under our political environment we have now, they're diversifying into gold. They're looking, in the case of a country like Russia, to de-dollarize and have many more ounces of gold relative to U.S. Treasury bonds and so on. So those are the four underlying forces that I think are at work here. And I think that if I had to sort of characterize where we're at, this still looks to me like the second or third inning in baseball terms of this move, because as you mentioned, it seems like many individual and institutional investors aren't necessarily really exposed to the market the way they probably should be now that we're coming out of this long period of sideways movement. So I think that given a relatively smaller market size in terms of gold and mining share capitalization and so on versus overvalued, overpopular sectors like technology, I think there's a lot of potential for money to rotate into mining shares and to help fuel further gains over the next couple of years.
Well, let's talk a little bit about bottoms and tops within markets, and perhaps that is the hardest aspect of investing. So do you have different strategies for both? And what would a top in gold look like to you? Do you have a specific price target, or does it really depend on the fundamentals at the time and what else is happening within the global economy?
Sure. I think that it's fair to say there is some top-like behavior in markets like stocks, in my opinion, and you're starting to see that to some degree in the credit markets as well. Excessive optimism, yield-chasing behavior in the credit markets, not necessarily government bonds, but riskier corporate bonds and so on. A lot of what's happening in the corporate debt market, for example, reminds me very much of what you saw at the very tail end of the housing mortgage boom/bubble that we had in the mid-2000s. So I'm a lot more cautious in those kinds of assets than I was, say, a couple of years ago, when I think this economic expansion and sort of the acceptance of risk had further to go. On the other hand, when you look at gold, silver, mining share capitalization, and so on, you're really not seeing the kind of excessive exuberance or chasing behavior that you would typically see in a top. You don't see the gold advertisements all the time on financial television. You don't see a lot of that sort of cocktail party or water cooler chat, about things like gold and gold stocks or silver and so on that you might see about technology, for example. I think you hear about FANG stocks and major tech stocks 5 times a minute or so on financial television, but they rarely talk about things like precious metals. So that sort of factors into the whole idea of, are we at a top? Are we early in this move? Everything that I'm saying suggests we're still in the early innings of this. So again, there's a lot of opportunities remaining ahead for investors over the next couple of years.
Okay, well, gold and silver and the miners like you've lined out look as though they have much further to run. But it'd be interesting to talk about perhaps the worst investment you've made in your career, or perhaps the biggest mistake, and in hindsight, why it did occur. Were you perhaps too early, or were you chasing instead of waiting and being patient? Can you talk to us about that?
Sure. If I look back at my career here at Weiss and even before I joined the firm, I think probably the biggest mistake that I made was staying too negative for too long coming out of the great financial crisis. I think I somewhat failed to appreciate the impact at the time, the significant impact at the time that monetary policy, whether we're talking about quantitative easing or deep interest rate cuts and so on, would ultimately have on asset prices coming out of the recession. I think that it's pretty fair to say if you look at underlying economic data points, whether it's on inflation, whether it's on GDP growth rates and so on, this has been a relatively anemic, though very long-lasting recovery in the underlying economy. All these inflation targets and so on that central banks have set, 2% or greater, and all these extreme monetary interventions globally to spur greater growth and inflation haven't done much on hitting those bogeys, but they have clearly had an impact on asset prices and asset valuations. So it took me a little bit more time than it should have to appreciate and position for that. But I think now we're almost at the other end of the spectrum where we've seen extreme impacts on asset prices, but to the point where many central banks now appear to be kind of pushing on a string. So just as it was a mistake to stay too negative back then, I think many investors may want to be cautious about getting too optimistic now, sort of being lulled into a sense of security by many, many years of asset market gains.
Yeah, some excellent analysis there. Okay, as we begin to wrap up, Mike, is there anything else you'd like to share with us today? And also, it'd be interesting if you could share a few books that have helped shape you as an investor throughout your career.
Sure. Again, I think that the biggest message that I would want to convey is, again, where we are in this move. I think you're still getting in at the relatively early stages of this cycle, this move in precious metals. And when you look at sort of the divergence between metals prices now and where they were at the peak back in 2011, 2012, versus where mining shares are now relative to their peak, you can see that there's not as broad sort of acceptance, in my opinion, yet in terms of the valuation of mining shares and the price level of mining shares of this move. It looks like shares have quite a bit of catching up to do to what the underlying market's doing. And I think that's just because there's still a lot of skepticism, a lot less acceptance of this move in mining stocks than you might otherwise expect given what's happened to the metal. So I think you're still early in this move. I think when it comes to understanding why, again, you're going to see these geopolitical short-term flare-ups that can impact the next couple of weeks or days or a couple dozen announced moves in gold. But when you look at things like the history of interest rates, where we are in this cycle, I think that it very much argues for a bullish move in gold. And some of the books that have kind of shaped my view may not necessarily be exciting reading or cocktail party chatter, but the history of interest rates is an incredibly dense but valuable book by Homer and Silla that provides a lot of perspective on what's happened in the past versus what's happening now. And I really do appreciate things like the book Fed Up by Danielle DiMartino Booth. She does a good idea as a former Fed insider of conveying some of the groupthink and some of the mistaken theories that the Fed and other central banks have adhered to and what that can mean for markets in both the short and long term. So those are a couple of things I would recommend.
Excellent. Okay, well, many thanks for your time today, Mike. It's been great having you on the show. I'm sure we'll have you back on later in the year.
Great. Glad to do it, and take care.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?